Good day, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on chart patterns and trend patterns. Now, for those of you that are joining us for the first time, ETX is a regulated provider, so I'm required to give you a risk warning. Trading in the financial markets may result in the loss of the amount deposited. Please ensure that you fully understand the risk and seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided during this webinar is for educational purposes only. All traders must understand that there's a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Now, ETX is a fast-growing financial services company based in London. We are authorized and regulated by the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. Now, tonight we're going to be using the beginnings of technical analysis. And technical analysis is a study of the financial markets based on price movement. It uses the assumption that the price of a share reflects all information about that share or that asset, including market sentiment as well as its perceived value. Charting refers to technical analysis that's performed through careful inspection of asset prices, price data for identification of well-known patterns to emerge. For example, a head and shoulders, a channel, a triangle, a wedge pattern. These are patterns that appear in the movement of prices in the charts. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occurs between the buyers and the sellers of financial instruments. Pattern formations do not form a trading system, but rather provide an indication of the future trend of a share as the price breaks key psychological barriers in the form of support and resistance. Now, I hope all of you understand that not one individual tool, not one individual indicator or oscillator is a trading system or a trading strategy. Each one of these elements we have in classes can be then put together to build your trading strategy or your trading plan, but not one will work independently to give you a trade. Okay? You should always be using a combination of one to the other, so that, because when these, in this case, when these patterns develop, they're trying to tell you something, but that's not guaranteeing you what the market's going to do. You need a secondary, if not a third, indicator that will support those interpretations. Now, there are numerous types of patterns, all named according to the shapes that the price graph forms between the support and resistance levels. The general type of patterns include triangles, channels, wedges, and head and shoulders. These are the most popular. You'll see other things out there, or sometimes you'll see other names. Some people call these pennants and flags. There's even one that's called a teacup saucer. But they're all basically based on the same understanding, using support and resistance lines and price movement on a chart. Now, when we come to triangles, which is the most popular pattern and the most well used, is just a triangle. It's a pattern that develops between a support line and a resistance line. And what it's showing you is that the price is beginning to get pent up within the triangle. And when it reaches the emergence of the two lines, or the part of the triangle, it's going to break out in one or two fashions. It can break down or it can break up. But it's showing you that the market is getting pent up. And when this pent up energy finally gets broken out, there are ways to evaluate that. So a triangle is formed between converging support and resistance lines. A negative sloping resistance line indicates a reducing level of profit taking or more uncertainty about the value of a share or an asset. With a positive sloping support line, the price levels are squeezed into a corner. Once the support or resistance line is broken, pressure that is built up as a result of uncertainty is released and a certain amount of momentum is added to the price change in the direction of the breakout. So in other words, I'm just trying to get my marker on here for you. Okay. In any of these cases, and we have the symmetrical, the ascending, and the descending triangle. And basically, the names of them just describe in what conjunction or what convergence you're having between the support and resistance line. So a symmetrical triangle is when support and resistance are merging in the same degree. An ascending triangle is when your support line is moving up like a trend line and your resistance line is staying basically horizontal. And a descending triangle is just the reverse. But in all cases, as price moves into this corner, it's going to break out. And there's no rule that says it's going to break down or break up. But there is a formula that is based on the amount of momentum that can be added to the price change. Okay, and it will help us then when it breaks out, tell us what level that asset should bounce to or should have the momentum to break through when it breaks out of that pattern. So this is one of the reasons we look for these patterns, because it's telling us that at this level, we're going to get some action. We don't know what it is. We're going to get a break out, but will it be a break up or a break down? We don't know. But once it does make the break, we can then determine how far that asset should move in the direction of the breakout. Now, there are specific variations of triangles that can occur, namely ascending, descending triangles. An ascending triangle has a horizontal resistance line, and a descending triangle has a horizontal support line. An ascending triangle usually occurs as a continuation of a bullish trend, while a descending triangle usually occurs as a continuation of a bearish trend. But there is no law that it cannot be the opposite. It takes a lot for the asset to move around to where it's the opposite, but it can work in an opposite direction. So we can see here in an ascending triangle, we have price moving up, and therefore we have the trend or the support line moving at an angle, and we have the support line staying fairly horizontal as they move into the triangle. In a descending triangle, we have the support line staying horizontal, and we have the resistance line, or actually it's the support line because price is moving down, so it's supporting that price movement. And this is the resistance line moving to form the descending triangle. Okay. Now, it's important to note that an ascending triangle can also be found in a downtrend. So the combination of the name of the triangle and the market trend is deceiving. Thus, the financial asset needs to test the resistance level twice, and the asset closing price needs to be higher than the previous closing price. In other words, the closing price has to follow the rising trend line. Okay, so in other words, it's very easy because if you're in an uptrend, the trend is moving up, means that the price is continually closing higher than that support line. Okay. Now, also we need to look at a secondary indicator, and this is volume. Next we come to volume. When in an ascending triangle, volume usually contracts. Although there are a few number of cases that show volume has not contracted, but the pattern has been displayed. This has been signified, we'll show it in the next chart, but it's not a hardcore rule, but if I'm going to trade them, I need volume to sustain or to support my interpretation of that triangle. So in other words, as price is moving into that corner, volume should be contracting because the traders, there's less volatility. The traders are trying to make a decision. Then when it breaks out, whether it's up or down, we should see an increase in volume. Now, when we see this, the primary reason that volume is very important is because in order to predict the momentum of the breakout, volume has to support it. Because if volume is still climbing, when you're getting into that triangle point here, okay, we have a very difficult time estimating how much the momentum will be because the buyers are already in the market or the sellers were already in the market. Okay. Now, the distance between the rising trend line and the rising resistance line will give us our projection. So in other words, the difference between here and here on a price chart, and you can see the prices on the chart, okay, will help us predict how much momentum or what price that asset should go to when it breaks out. Okay. So in other words, if our resistance level was a value of 1 here, and our support level, or I'm sorry, so if our resistance level had a value 1 and start out at our trend line had a value of 0.5, so this was 1, this is 0.5, then our upward value would be 1.5. So we would expect it to come out 1.5 or 1.5 times the distance between the resistance and the trend line or the resistance and support line when it gathered that momentum to break out. Okay. And the same formula holds true whether we're calling something a rectangle, a wedge, or a triangle. These are just other forms of support and resistance developing into a pattern. Now, when we have a rectangle, what we do is we have a horizontal support and a horizontal resistance line. And a lot of times we call these double tops or double bottoms or triple tops and triple bottoms, because what happens is the price is falling down, touching a resistance line, bouncing off and coming back to, it's falling down and hitting a resistance line, coming back up to the support line, falling back to the resistance, coming back to the support. And what do we have is we actually have a double top or a double bottom, depending on whether price is moving up or down. And this forms the rectangle. In a channel, what we have is the speed or the angle of the downtrend and the support and resistance line remain constant. So one, you have sideways motion. One, you have a continued downtrend making the peaks and the valleys, and you have the reverse for an uptrend. So a channel is formed between parallel support and resistance lines. Okay. Now, you don't make these up. These are just the lines that you're able to draw on the charts by the peaks and the valleys or the highs and the lows of that asset price. When you can draw lines between those highs and the lows or the peaks and the valleys, and you get them moving sideways or horizontally, then it's just a rectangle. When they're moving downward or upward in the same degree, then you have a channel. So here you can see on the charts the channel in the upward movement or an uptrend, and then a channel in a downtrend. Again, you're not fudging these. You're not trying to make them up. It's simply when you connect the highs and the lows and are able to draw in your support and resistance lines that they form these channels. Okay. And rectangles or triangles are also sometimes referred to as flags and pennants. Okay. Now, a flag would be defined as a bullish continuation channel down or a bearish continuation channel up. Lots of words. Bearish means weak. Continuation, channel up. Channel's moving up, okay, and bullish is a channel moving down. Then we have wedges. Wedges, again, are like rectangles, channels, rectangles, triangles, I'm sorry, they are simply when the support line and the resistance line are forming almost into a triangle, and they're wedging the price into the center, but you don't have a horizontal or a parallel, horizontal support or resistance line, and you just don't have that formation. Remember, in the triangles, you either have both the support and resistance line merging together. You have a horizontal support line or a horizontal resistance line, whether it's an ascending or a descending triangle. So wedges are similar to triangles, and the patterns are formed between converging support and resistance lines. However, where the support and resistance line in a triangle have one positive and one negative slope, the support and resistance lines in a wedge would both have either a positive or negative slope. Wedges with positive slopes are called rising wedges, and wedges with negative slopes are called falling wedges. Okay, if you didn't tell the difference, you called them a triangle, you'd be perfectly fine because the interpretation is exactly the same. Okay, so it just gives you a more defined set of rules. To me, they're all triangles. Okay, I look at basically rectangles, because a rectangle is the most different of all the triangles, because that's a sideways moving action, and because that can be a double top, a double bottom, a triple top, or a triple, and you can have a lot more expressive determination there. But otherwise, they're all defined pretty much like triangles. Now, wedges, the most common wedges are found as breakouts in the opposite direction of the wedge. That is a bearish breakout in a rising wedge. So this is a rising wedge. And what you're doing is you're having price move into congestion here, but as the trend is moving up, so it suggests that it's going to break out because the buyers and sellers are leaving the market, and there's some uncertainty, but there's no guarantee. You need to use it with secondary support, but it's usually a bearish breakout. Opposite in a falling wedge, which occurs in a downtrend, opposite thing is a bullish breakout. So just remember, in every case, there is one for uptrends and one for downtrends. And then the most talked about pattern is a head and shoulders pattern. Okay. Now, the thing is, you can spot these patterns way ahead of time because you don't have any idea whether you're looking at triangles. You can see as they're developing. You see price moving in, you get your trend lines in there, and you're looking for the price to move into the center of that triangle. Whereas a head and shoulders, it's very difficult to see before, because otherwise you could have a billion things that look like a head and shoulders pattern. A head and shoulders pattern, you have to wait for it almost to be developed to be sure that you have something going on. But when you do, they're pretty reliable. Now, a head and shoulders patterns is just exactly what the name implies. You have a pattern that develops two shoulders, a neckline, and a head. Okay, so it's a head and shoulders. Or the upside down, or the exact opposite, is an inverted head and shoulders. Again, because you have to have one for an uptrend and one for a downtrend. But head and shoulders is a reversal pattern from a bullish trend to a bearish trend. The pattern starts when the graph crosses the support line upward before a formation of the left shoulder, and is completed once the graph crosses the short line downwards after the formation of the right shoulder. So in other words, when price is moving up, I'm just trying to get these off here. When price is moving up, you'd have no idea that it's forming a shoulder here because price is constantly moving in peaks and valleys. It moves up, comes back down, and then reverses and moves back up. But you still don't have anything here. When it comes back down again, and it forms the neckline, because now you have a support line that connects here, here, and here. Okay. We've already got the head, and the head needs to be higher than the shoulder. It's just like your head. It's your neck, and then your head sits above your shoulders. Okay. Now, the shoulders don't have to be exactly even. They have to form like shoulders. Some of us have a higher left shoulder than a higher right shoulder. You can be bent over, but you have to have a head that is higher than the shoulder. We're going to talk about how you determine that in a minute. Okay. But then it moves, price moves back up. So, you've got a lot of price movement here. It's not until it forms the right shoulder that you actually can say you've had a head and shoulders pattern. But when you do, okay, then you have a very, very strong indication of a market reversal. And you'll hear about head and shoulders a lot. It doesn't happen that often, but when they do occur, they make a lot of news and headlines. So the popular head and shoulders pattern is essentially a triple top pattern, except that instead of all the peaks hitting the same resistance level, the head peaks slightly higher than the shoulders. Some investors have specific beliefs about the amount of bearish fallback that would occur between tops, with some allowing a 10% loss before the price returns to the test, and some require at least a 15%. Regardless of opposing views, these patterns are very popular among traders and analysts as they predict true reversal with relative reliability. Signal strength is bolstered by agreements from other indicators such as waning volume as the trend nears exhaustion. So remember, your head must be higher than your shoulders. There is no formula for how high your head has to be. It just has to be higher than your shoulders. So it's like human beings. Some people have long necks, some people have short neck, some people have high foreheads. It still has to look like a head and shoulders, and this is what the pattern looks like. Okay. Because we will get to applying formulas to these in a second, but as you can see, it's kind of hard to even notice it in the marketplace. On a chart, here you have price moving up. It moves up, forms the shoulder, comes back down, moves back up, forms the head, comes back down, touches the shoulder, moves back up, and then it breaks out. But it's very, very hard to recognize it when you're actually looking at a chart and price movement. But because it develops fairly slowly, you have ample time to see it and analyze it, because you're not going to have it up, down, up, down, up, down form be over with. So you'll see when you see a resistance line and then you see it break that higher, come back down, you have time to see it, but it's very hard sometimes to actually find these in a chart. But once you start recognizing them, you'll find that you can locate them. Now, there are some formulas. You should write these down. They're not very complicated. They're easy to do. They're easy to remember. Now, we're going to start out with a head and shoulders. Now, a head and shoulders indicates both the end of a trend and the possible change in the direction of the asset's movements. The given pattern is formed in an uptrend representing 3 peaks. Now, to calculate this, when we see the development of the pattern, the first thing we have to do is truly find the neckline. Once we found the neckline, okay, we can draw a line across that, because that's your support line of the price movement anyway. You have your head, which again is you have your left shoulder forming here, your right shoulder forming here. And there isn't a formula between how high the left shoulder has to be to the right shoulder. All it is, it says the head has to be higher than the left and the right shoulder. But again, you can be bent over, you can be a hunchback, whatever. Okay. When the price forms the right shoulder and moves down and breaks below, it gives you that sell signal. Now, you want to determine targets or momentum that that breakout should have. So you would calculate this breakout by this simple formula. Target equals neckline minus the head minus the neck. So our target price is the price we would expect it to come down to based on the momentum. Okay. We have, so what we do is, and I'm just going to make up some numbers for this. So let's say the neckline is at 10. The head is at 15. And that's where it actually is. It's just a number on the chart. The headline's 10. So we would take the target price for the breakout would be 8 T, which is target price, is equal to the neckline, which is 10, minus the head, which was at 15, minus the neck. So it actually is the height of the total movement. Okay. So in other words, we have 10, which was the neckline, minus 15 minus 10, which is 5. So we have 10 minus 5. Or our momentum breakout should be equal to 5. Is that right? 15 minus 10 is 5. 10 minus 5 is 5, yes. Okay. So this, and if you look at this, this is equal scale because here it's 15, 10, and this would have been 5. Okay. But in a real price chart, you would use the numbers actually on the price chart because it is the movement that asset actually made, the prices it was reaching. Okay. In an inverse head and shoulders, which is just a flip reversal, it's exactly the same formula reversed. So you have your target is equal to the neck plus the neck minus the head. Okay. Now, a multiple top chart pattern occurs in an ongoing uptrend. It indicates the trend is nearing exhaustion. If a security repeatedly has difficulty surpassing a certain price point, a multiple top pattern forms. So in other words, if price was moving up in a chart, price was moving up in a chart, and it hits that resistance line and breaks, bounces off of it, comes back to that resistance line, bounces off it again, comes back down and bounces off of that resistance line again, that gives you a multiple top. You have the exact opposite for multiple bottoms. You could have a double top or a triple top. Double tops happen quite often. They give you some indication. When I see a triple top, I'm saying, okay, the buyers can't push that price above that resistance line. Okay, they've tried 3 times. So therefore, I'm going to expect for that price to fall because the buyers just can't break higher than that. So each time an attempt is made, the price falls back near the point, creating a support level where bulls shore up the security. So in other words, every time the price falls back down here, they start buying back up again, support the price, but they can't get through this resistance line. Eventually, the bearish pressure that prevents security from breaking above the resistance level pushes prices below the support, causing a trend reversal. Okay, again, a double top or double bottom happens often. It's an indication. A triple top or triple bottom happens less frequently. So therefore, the more reliable signal is the triple. Okay. Now, for the formula, is actually almost the same formula as we used before. It's the target is equal to the support level minus the height between the support level and the top or the resistance level. So in other words, if we go back and this was the support level was here at 10, our resistance level that each time that it made that Again, this is a double top. I would use a triple, but each time it hit that resistance level, bounce back down, okay, bounce back up. Okay, that support line was at 10. Our top was at 15. You would simply calculate the target for the breakout would be equal to our support line, which is 10, minus H, which is the height of this, the movement of this pattern. So between 10 and 5 was 5. Therefore, it's 10 minus 5 is 5, or our target would be the 5. Can you hold on 1 second, please? Sorry about that. Okay. And double tops or triple tops or the reverse have the same calculations. But again, a triple top or a triple bottom are a reversal pattern that touch either the support or the resistance line 3 times. And this is why they are a stronger signal, because you have the third support or resistance level. Again, I don't use the doubles. Okay. And the formula is still the same. Now, an important measure of the quality of the pattern is the trend that precedes it. You cannot just simply look and see, oh, there's a triangle, I'm going to make a decision. Understanding the quality of the trend is the price, because if a trend line is about to be broken, or not a trend line, but the price trend is about to be broken, but it was a very erratic trend and all over the place, it's not going to have much of a response to you. Where if you had a strong trend or a well-defined trend, then it's a better signal, because it's going to give you a better quality of a breakout. So you have to always look at how well formed the trend is that this pattern is occurring in. Okay. Now, a pattern is said to have broken out once it has crossed either the support or the resistance line. If the pattern broke out in the same direction as the preceding trend, it is called a continuation pattern. If a breakout is the opposite direction, it's called a reversal pattern. For example, a pattern described as a bullish reversal triangle would mean that it's a bullish signal, that is, and the breakout was through the resistance line upward. Because it's a reversal pattern, that means the preceding trend was in the opposite direction of the breakout. That is, the preceding trend was bearish. So again, these are the predominant formations, and you have the same simple calculation. It is really based on the magnitude of the difference between the height of the resistance and the support line to calculate your target point. And when you have your breakout, you would it would enter when it broke out, whether break out or break down from that pattern, you would set your target based on the formulas we looked at, place your stop loss based on the resistance line or the support line, depending on which way it's broken out. But you can use these to make some judgment, but do not trade from these without other supporting factors. Okay. So I want to take you over, and I've got some live charts set up, and let's go look at these in some live charts that are moving as we're talking. So hold on, let me pop these up. Okay, so here we have the Bitcoin US dollar in today's trading. This is an actual up to the minute chart. Okay, we can see this beautiful triangle that's formed. And we have a double triangle because the price came out of the green triangle here. Let me get my markers on here. Okay. We have this beautiful triangle that's formed. Look at how much the height of this triangle meets with the height of this triangle. Now we're in the formation, or we're predicting the formation of the secondary triangle. We have the price moving, bouncing up and down, and we're now predicting the price to come down to here use this as our support line, and we would look at to form somewhere a breakout of the triangle somewhere around here. But again, this doesn't work without other supporting factors or other supporting indicators. But these are beautifully formed triangles using, look at this. Here's your support line drawn connecting all the lows. Here is your resistance line connecting the highest high and pulling right down on top of them. And you have an absolutely magnificent triangle. Here's today's longer term New Zealand dollar, US dollar. Look at the perfect formation of the price. Let me get my markers off of here. Okay. So we have the long-term resistance line following across here from all the way back in February. We have our trend line, our bottom line, our support line, beautifully supported. Now, a support line isn't exactly like a trend line, because a trend line can't have any breakage going through it, and it needs 3 points of validation, whereas a support line is simply the price that supported the lows as price was moving up or down. So we have our resistance, our support line, and look at the congestion we're going into right here. Okay. And we're expecting a breakout to come down, and this is where we're expecting our target level to go to. Then we go over here to a beautiful falling wedge. That's, again, this is happening today in live markets. Now we did get our breakout. Okay, so look at the breakout, and this is where we were expecting a breakout, and it was predicted, and this breakout has occurred, over the last day or two. But this is where, from the wedge, what we were expecting in a falling wedge for the breakout to be upward. And we've got that. Now we're hoping, based on our formulation, that this is where the momentum will take us. But these are patterns. These are patterns that you simply draw on the charts, connecting your highs and your lows. If you don't understand what support and resistance are, you need to come to our class in support and resistance. Okay? But you're simply using the lows to connect the line together. They're just simple support lines. There is no rule or law. It is what is the price that is supporting the current movement. And by connecting the lows and looking for where you've had past action or reaction of those prices, you get your support line or your resistance line. Okay. Moving up, this is a downtrend. So your support line is above the price because it's supporting that price as it's falling down. And you're simply drawing that line. And if you're finding this by finding many points in common, and look at all of these, when you drop this line in there, look at all those points that it's being supported. Your resistance line is also exactly the same. And by putting these on, by using the rules of support and resistance, you then see that they're forming a wedge. So you would have it where the resistance line happened to go that way. Okay, you didn't have a wedge, and you might have nothing. Okay, but that's it. Is visually supporting those. And what is support and resistance? Okay. Time frames have absolutely nothing to do with chart patterns. If you're working in a half-hour chart and that's what you're using, you find the chart patterns in your half-hour chart. Okay. It's based on your trading strategy. So if you're day trading, you're not going to use a pattern that's going to take over. Like gold right now just finished a beautiful head and shoulders action, but it's taken 6 months for this that wouldn't have helped you if you were day trading gold. So your patterns are developing on your existing price charts based on the time frame you're using on your chart. You're not trying to find a pattern and then move it to your trading style. That's a no-no. You're not adjusting. You're not trying to make something happen. So remember, it's to use this to incorporate into your trading plan. It's recognizing the patterns on the chart you're using, not adjusting a chart to find a pattern. And that's very, very important. You don't want to force these things to happen. Okay. You can use them in combination with Fibonacci retracement levels. Okay. And once you figure out what the patterns are and then add them with retracements, you can then also help to predict whether it's a retracement or a reversal pattern. And this will help you also give you clues to be exiting the market or if the trend is about to end. Okay. So it'll help you make your trading decisions when you can understand whether you're looking at a reversal or a retracement. So guys, on that note, I'm going to say goodnight to you. It's very, you need to come to our class on support and resistance if you don't understand how to draw these lines. If you do understand how to draw them, but you're not sure how to use them, come to our class on Fibonacci retracement or come to our class on support levels. Now, we have 3 brand new classes coming up next month. We have a class in MACD, a class in, I forget what they were. They just approved them today because I turned them into compliance. Let's see. A class on MACD, moving averages, convergence, divergence. We have a class, on mastering trend price, trend trading. And we have a class in, I don't remember what the third class. We have a whole bunch of new classes coming up for you in August, September, and October. So watch, they'll be on the schedule in a day or two. But thank you very much for joining us tonight. We'll talk to you again and have a great trading week. Remember, the big deal this week is going to be Mr. Draghi tomorrow with the ECB rate decision and then his press conference right after that. Listen carefully to what he says about quantitative easing and the ECB balance sheet. And just get his demeanor. If he's more positive about the European economy and inflation, we should see the euro climb a little. But you're going to get some market volatility tomorrow. So thank you very much. Have a great trading week. Thanks for being part of the ETX family. Good night now.